You know, usually when we look at a business in distress, the symptoms are, well, they're pretty unmistakable, right?
Oh, absolutely. I mean, the revenue dries up, the margins start to compress, and the market just sort of, it moves on to the next big thing.
Right, exactly. Customers flee to competitors, product lines feel dated, and you just have inventory gathering dust in a warehouse somewhere.
Yeah, it is a very linear, predictable path to failure. You can see it coming a mile away.
Right. But consider the exact opposite scenario for a minute. A business that is experiencing a level of success so overwhelming, like so flooded with red-hot demand, that it's essentially choking on its own phenomenal growth.
Which is, frankly, a wild problem to have.
It really is. I mean, you look at their server racks, and they are utterly maxed out. They've secured hundreds of billions of dollars in guaranteed future contracts.
Hundreds of billions. Yeah.
And yet, despite all of this, undeniable commercial success, their stock recently plummeted over 57% from its 52-week high.
Yeah, and their credit rating is teetering right on the very edge of junk status.
It's crazy. Okay, let's unpack this. Because how does a company with seemingly endless AI demand end up putting its financial health on life support?
It is arguably the most fascinating financial paradox of 2026, hands down.
Welcome to this deep dive, everyone. Today we are looking at a huge stack of equity research, credit ratings, and market sentiment reports, and they're all centered around Oracle.
Oracle,
Yeah.
yes. You are looking at a massive enterprise, risking its entire foundational balance sheet just to keep pace with an insatiable market appetite for its infrastructure.
Right. And before we can make sense of the market's sudden panic here, we have to establish the sheer scale of the demand Oracle is currently wrestling with.
Because ironically, their unprecedented success in the AI space is the exact mechanism that's draining their liquidity.
Exactly. So let's look at the operational metrics first, because if you isolate just the top-line numbers, this company looks, completely unassailable.
Oh, for sure. Oracle's revenue growth on a trailing 12-month basis is clipping along at 17.35% year over year.
Which is massive for a company of that size.
It is. And they are operating with a gross margin of nearly 66%. Plus, they're dropping 25.37% straight to the bottom line as net margin.
Wow.
At Oracle's scale, maintaining that level of profitability during a massive growth phase is highly, highly unusual.
Yeah, but the utilization metrics are what really jumped out at me from these reports. Global GPU utilization hit 97.5% in their latest quarter.
It's basically perfect efficiency.
Functionally, yeah, it means there is zero idle compute across their entire global footprint. They are running their hardware at the absolute physical limit.
Barely leaving enough margin for basic maintenance or redundancy, really.
Right. And what's fascinating here is the stickiness of that demand, right?
Yeah, exactly.
Yeah.
Out of all those deployed GPUs running at max capacity, 92% are seeing their contracts renewed by the original customers.
So the compute power never even hits the open market.
Never. And for the remaining 8% that does turn over, well, those instances are snapped up by brand new customers within 90 days.
That's insane. The sales cycle for their core product is virtually non-existent at this point.
Right, because the product is effectively sold before it's even provisioned in the data center.
Which brings into focus their remaining performance obligations, or RPO. For anyone tracking future cash flows, RPO is like the golden metric, right?
Yeah, it represents contracted revenue that is absolutely guaranteed to hit the income statement over time.
And Oracle's RPO right now stands at a staggering $638 billion.
It's a colossal number. And Morningstar is actually projecting an average annual revenue growth of 31% for Oracle over the next 5 years.
Fueled almost entirely by this AI cloud infrastructure build-out, I assume.
Precisely. By fiscal 2030, they model that cloud services will account for roughly 85% of Oracle's entire revenue base.
So they are rapidly transforming from like a legacy database software provider into just a pure-play AI infrastructure behemoth.
That's the bull case in a nutshell. Rapid top-line growth, fat profit margins, perfect utilization, and a $638 billion backlog of guaranteed future revenue.
But, and here's the massive twist, the bulk of this revenue stream is being completely devoured by capital expenditures, or CapEx.
Devoured is the right word for it. Building the physical AI cloud infrastructure required to actually process all this demand is breaking the bank.
Right. In fiscal 2026, Oracle spent $56 billion on CapEx.
And for fiscal 2027, they are forecasting an eye-watering $90 to $95 billion in capital expenditures.
90 to 95 billion. That is just, That unprecedented level of spending has plunged Oracle straight into negative free cash flow territory.
Well, the mechanics of building out modern AI infrastructure require an unbelievable amount of upfront capital.
Procuring the land, securing the massive power grid connections.
Installing specialized liquid cooling systems
Right.
and then, outfitting them with tens of thousands of premium GPUs.
Right. More cash is bleeding out to construct these digital factories than is coming in from all those highly profitable software sales.
Yeah.
It's the equivalent of, imagine a mid-sized construction firm winning a historic contract to build 20 skyscrapers across Manhattan, right?
Yes, I see where you're going with this.
The payout is guaranteed upon completion, but the firm has to purchase all the cranes, secure the steel, pour the concrete, and pay the entire labor force up front.
Out of their own pocket.
Exactly, out of pocket, before the city issues a single check. So is this just the unavoidable toll of competing in the modern AI wars, or did Oracle, fundamentally miscalculate here?
Well, what's fascinating here is that the equity analysts are heavily penalizing them for that exact dynamic.
Despite the $638 billion in guaranteed future revenue.
Despite all of it, analysts at Morningstar and UBS are actively trimming their fair value and price targets.
Oh, wow.
Yeah, Morningstar cut their fair value estimate to $207, and UBS lowered their target to $245.
So why cut the targets when the demand is so high?
The rationale is purely mechanical. Those massive $95 billion CapEx forecasts are completely suffocating Oracle's free cash flow generation.
Right, because you can't value a company on future profits if the present-day cost to achieve those profits threatens the actual solvency of the business.
Exactly. You cannot spend $95 billion out of pocket when you're operating with negative free cash flow without someone eventually knocking on your door to collect.
And that forces us to look at the debt markets, which is the exact catalyst for this recent massive stock sell-off we've seen.
Yes, the balance sheet.
Oracle's debt load currently sits at $129.5 billion. That places their leverage at roughly 4.3 times their EBITDA.
And the credit rating agencies are watching that leverage ratio like hawks right now.
Yeah, in July 2026, S&P Global Ratings downgraded Oracle's credit rating to BBB-.
Which is a huge deal because being downgraded to BBB- puts Oracle exactly one notch above speculative grade.
Right. If they slip one more rung, their debt is officially classified as junk.
And Fitch, another major rating agency, explicitly warned that if Oracle's sustained leverage remains above 3.5 times today,
Or 4 times if you factor in their rent obligations.
exactly, it will trigger another negative ratings action. And Moody's has gone a step further.
What did Moody's say?
They warned the market that Oracle's leverage could temporarily spike toward 5 times EBITDA as this infrastructure build phase peaks over the next 12 months.
Wow. And Morgan Stanley's credit analysts highlighted what they call the fallen angel risk here.
Yeah, holding too low BBB ratings puts Oracle right on the precipice.
If they lose that investment grade status, it triggers a catastrophic mechanical reaction in the bond markets, right?
Oh, absolutely. Institutional investors, pension funds, major asset managers, they often have strict mandates that forbid them from holding speculative grade debt.
So if Oracle gets downgraded, those institutions are just forced to liquidate their Oracle bonds en masse.
Which spikes Oracle's borrowing costs at the exact moment they need to borrow another $90 billion to finish building these data centers.
Okay, but wait a second. Let me push back on this a bit. Microsoft, Amazon, Google, all the dominant hyperscalers are spending tens of billions on their own AI infrastructure.
Sure, they're all building massively.
We track their CapEx expansions every single earnings cycle. So why is Oracle being isolated and punished so severely by the credit agencies for doing the exact same thing?
Well, if we connect this to the bigger picture, the distinction lies entirely in the starting line.
The starting line.
Right. Microsoft, Google, and Amazon certainly have massive CapEx burdens, but they are infinitely better capitalized.
Oh, because they generate colossal amounts of free cash flow from their legacy businesses.
Exactly. Search, AWS, Windows, Office, they entered this AI race sitting on massive piles of cash.
Ah, I see. None of those hyperscalers began the specific build-out phase highly leveraged, nor did they dip into negative free cash flow to fund it.
Right. Oracle's effectively funding a generational infrastructure build entirely on credit, whereas the big three are funding it from their operating cash flow.
Which brings up a very specific and honestly highly dangerous structural vulnerability detailed in the research regarding Oracle's lease obligations.
Yes, the leases. This is critical. Oracle has signed approximately $260 billion in data center lease agreements.
$260 billion.
And the vulnerability there is a massive duration mismatch.
Right, because Oracle is signing 15 to 19-year lease terms for the physical real estate, like the actual concrete and steel data centers.
However, the customer deals the contracts with the AI companies paying to utilize those servers. They only average about 5 years in length.
That is a terrifying operational gap. I mean, they are legally bound to pay rent on these massive industrial facilities for nearly 2 decades.
But the revenue flowing into those facilities is only guaranteed for 5 years.
Right. S&P's analysts flagged this exact mismatch as a primary driver of the downgrade.
And the mechanics behind it are understandable from a real estate perspective, honestly.
How so?
Well, a developer building a state-of-the-art 100-megawatt liquid-cooled facility requires a 15 to 20-year commitment to amortize those massive upfront construction costs.
Right, that makes sense. But the tech companies buying the compute power won't commit beyond the lifespan of the current silicon generation.
Exactly. A cutting-edge GPU today will be obsolete in 5 years, so they only sign 5-year contracts.
And to complicate matters further, Oracle does not own these physical data centers. They're just leasing them.
So they cannot liquidate the buildings to raise emergency cash, and they can't pledge the real estate as collateral to secure better loan terms.
It just drastically restricts their financial agility.
Extremely. And this precarious financial tightrope isn't being walked in a vacuum either.
No, the broader macroeconomic sentiment in mid-2026 is already incredibly fragile.
And some high-profile investors are aggressively targeting structural vulnerabilities exactly like the ones Oracle has built into its balance sheet.
Right, like Michael Burry. He's been highly vocal recently, actively shorting several AI favorites.
Yeah, he is pointing to a massive, hidden buildup of leverage beneath the surface of the soaring cloud computing demand.
His macro thesis basically argues that the entire sector is overextending on infrastructure debt, just assuming that AI demand will grow exponentially forever without a single cyclical correction.
And while Burry's thesis targets the broader AI ecosystem, it reads like a direct indictment of Oracle's current strategy.
It really does. Highly leveraged, executing a massive physical build-out, entirely dependent on future cloud demand, remaining perfectly inelastic for the next decade.
Which forces us to look much closer at that $638 billion in future contracted revenue we talked about.
Okay, here's where it gets really interesting for you listening. You see a number like $638 billion in backlog, and you assume a company is completely insulated, right?
I think so, yes.
A backlog that massive implies deep diversification across thousands of enterprise clients, but the data actually reveals a startling customer concentration risk.
Because nearly half of Oracle's entire RPO is tethered to just one single entity, OpenAI.
Just one company. You have nearly $300 billion in future revenue expectations resting squarely on the shoulders of OpenAI.
It's staggering.
Think about the restaurant analogy again. You own a high-end restaurant, and your reservation book is completely full for the next 10 years.
Sounds great on paper.
Right, it feels unbeatable.
Yeah.
But then you audit the ledger, and you realize that half the tables every single night are booked by one specific startup.
A startup that is brilliant and highly capitalized, sure, but is still actively trying to figure out its own path to long-term profitability and sustainable pricing.
Exactly. What happens to Oracle's flawless utilization rate if OpenAI decides to alter its compute strategy?
Or what if OpenAI decides to build its own proprietary data centers? Or what if their venture funding experiences a sudden chill?
The systemic risk is just immense. If OpenAI pivots its architecture or faces a structural hurdle, a massive portion of Oracle's contracted revenue simply evaporates.
But because of that duration mismatch we discussed earlier, Oracle is still legally obligated to service those 15 to 19-year real estate leases.
Right. The multi-million-dollar monthly rent for those data centers is still due, regardless of whether OpenAI servers are humming inside them or just sitting idle.
When you lay out the mechanics of that risk, the market's severe reaction over the last few months is entirely rational.
And we're seeing that caution reflected internally as well, right? The research notes a clear trend of insider selling.
Yes. Over a recent 90-day window, insiders at Oracle sold a net of over 387,000 shares.
Now, some market observers point to unconfirmed squeeze watch metrics, arguing that the heavy short interest might trigger a speculative short squeeze.
Yeah, but you really cannot ignore the verified insider selling.
When the executives with the clearest visibility into the cash flow models and the capex burdens are quietly reducing their exposure, the broader market is going to take notice and adjust risk premiums accordingly.
Absolutely. So we have the looming threat of credit downgrades triggering institutional sell-offs, Michael Burry sounding the alarm on sector-wide leverage.
A daunting debt load and an extreme concentration of future revenue tied to OpenAI.
The narrative sounds incredibly bleak.
It does. Yet when we analyze the recent price action, the stock is actually showing some resilience.
It is. It fell from a high of $345.72 back in September 2025, crashing all the way to $114.50 by late July 2026.
But it has since climbed back to around $147. So how does Oracle actually navigate out of this corner?
Well, this raises an important question regarding market efficiency. Has the market already fully priced in these worst-case scenarios?
That's the big question.
With the stock down 41% over the last 52 weeks, the price-to-earnings ratio has compressed significantly down to 24.78.
And a PE multiple of 24 for a tech infrastructure company projecting 31% annual growth. I mean, that suggests a tremendous amount of fear regarding the debt, and the CapEx burden is already baked into that $147 valuation.
Exactly. If the bad news is already quantified in the current price, then Oracle's path to recovery relies entirely on their operational execution over the next 12 to 18 months.
And they have several major catalysts on the horizon, starting with the Q1 fiscal 2027 earnings report coming up in September 2026.
That September earnings call will be the defining moment for their fiscal year.
The market is going to be scrutinizing one specific metric, right? The conversion rate of that $638 billion RPO backlog into actual tangible free cash flow.
Yes. Oracle has to prove they can turn those signed contracts into realized revenue fast enough to prevent their debt-to-EBITDA ratio from breaching that 4.5-time threshold.
If they can demonstrate accelerating cash generation, the threat of the S&P downgrade recedes, and the whole fallen angel narrative loses its teeth.
It is essentially a race against the clock at this point.
Can they pull the cash in faster than the CapEx debt piles up?
And the research indicates they have a very specific strategy to bridge that gap using customer prepayments.
Right, customer prepayments. That is their primary lifeline right now. Oracle is guiding that they expect to collect between $20 and $25 billion in customer prepayments.
Functionally, this acts as interest-free financing from their own clients.
Which is brilliant if they can get it. If they can secure $25 billion up front, it goes a long way toward funding that massive $95 billion CapEx plan without forcing them back into the hostile debt markets.
And without diluting their current shareholders by issuing new equity.
Plus, they are aggressively working to solve that OpenAI concentration risk we talked about.
Yes, the new Google Cloud partnership.
Exactly. Integrating Google's Gemini AI models directly into Oracle's enterprise applications is a massive strategic shift.
By deepening ties with Google and broadening their AI offerings, they are actively trying to attract a wider array of massive enterprise clients.
If they can successfully diversify their customer base and dilute that reliance on OpenAI, the structural risk profile of the company changes completely.
Dramatically, yes. If they pull that off, buying at a compressed 24 PE ratio could look like a generational bargain in hindsight.
Because the demand side of their business model is, frankly, unassailable.
The GPU utilization is flawless, the product is superior, and the market desperately needs what they are building.
Right. The entire crisis is isolated just to financing and execution.
Yep. If they successfully navigate the leverage ratios, secure the prepayments, and avoid slipping into junk bond status, the market will inevitably re-rate the stock based on its underlying earnings power rather than its balance sheet vulnerabilities.
So what does this all mean for you? If you are tracking the enterprise technology space, Oracle has positioned itself as the ultimate high-wire act of 2026.
Without a doubt.
On one hand, you're looking at undeniable historic demand. They possess an infrastructure product that the entire market is clamoring for, backed by hundreds of billions of dollars in guaranteed future contracts.
But to service that unprecedented demand, they have absorbed a staggering debt load,
Created their free cash flow, and placed themselves on the very edge of a catastrophic credit downgrade, all while tethering half their future to a single customer in OpenAI.
It's a lot to weigh. And I think the duration mismatch is the concept that really requires deeper consideration before we go.
Yeah, leave us with a final thought on that.
Think about the physical reality of signing 15 to 19-year leases for concrete and steel data centers, backed only by 5-year customer contracts for the hardware running inside them.
Because we are currently witnessing an era where AI hardware is evolving at breakneck speed.
Exactly. The chips are getting exponentially faster, running significantly hotter and requiring fundamentally different power architectures and advanced liquid cooling designs with every new generation.
So the physical infrastructure required to cool an AI cluster in, say, 2030 might look completely alien compared to the facilities being built today.
Which is exactly the point of risk. What happens to a physical, highly specialized data center in year 10 of a 19-year lease?
Wow, yeah.
If the underlying hardware fundamentally changes, will Oracle be trapped paying massive monthly premiums on obsolete real estate that can no longer support the demands of the next generation AI wave?
They're anchoring themselves to physical liabilities in a digital ecosystem that is evolving faster than the concrete can dry.
That's a great way to put it.
That is a fascinating and deeply sobering perspective on the physical limits of cloud computing. If you're watching how this plays out, keep a very close eye on Oracle's September 2026 earnings report.
It's going to be the most important call of their year.
We will see if they can start converting that massive backlog into cash, secure those prepayments, and successfully thread this impossible needle. Thank you for joining us on this deep dive. We'll catch you next time.